Welcome to the May monthly market report for 2022. I'm David Childers, and for the next 20 or so minutes, Kate Rezebeck and I are going to walk through some of the biggest topics in real estate today. Anything from, this crash question, is the market going to crash? Second, where prices and where things are heading for the rest of the year. And we'll talk about affordability as well, a big question on a lot of people's minds. Our goal is to give you the visuals and the information you need to be the expert in everything that you communicate to your clients. So let's hop right in and get started here. First question, why we're not heading for a housing bubble. You just about can't turn on the news or look at something and not hear something about the housing market, and that may have some sort of inference, or certainly the headline, is this a bubble in the housing market? Well, we wrote a blog on this just a few weeks back titled Why This Housing Market is Not a Bubble That's Getting Ready to Burst. And sort of the central point of that blog post was this graphic right here. And this shows home values going all the way back to World War II. And if you think about that, the reason we go back to World War II is that was the start of the modern day housing boom here in this country. You think about GIs coming back from the war, the GI Bill provided for education, provided for them to go out and buy a home. And ever since then, up until today, there's been one time in this country where homes lost significant value, and that was back in 2008. So back in 2008, we saw homes lose value really for two reasons. First reason, loose lending standards. You think back then, no income, no job, no verification, and we know how that ended up. The second reason was, cash out refinances. People took the equity they have, cashed it out, bought, jet skis, went on vacation, financed lifestyle, did things, thinking this will never end, and it ended poorly. So let's recap there. You apply for a loan that you don't have to qualify for, and then you take your equity and you cash it out. And that's what ended up in 2008 when homes lost value. So I'm going to break down in just a minute. We've got some new graphics of how this market is different. But it's important as we set up this conversation that we understand that's the one time homes lost significant value in this country. Now, the other question that sort of plays into this crash question is everything coming out of the past 2 years in COVID and forbearance. Remember the tool given to those to help weather the storm in their housing payments, homeowners that maybe had trouble with that, and that it's caused a lot of concern for a lot of people and what's going to happen there. Well, the forbearance numbers continue to edge downward. As of the most recent numbers in April, 690,000 loans still in forbearance, well below where we started out of May of 2020. We follow this story. If you've been following the monthly market report, that we've gone along and said, okay, what's happening to those coming out of forbearance, and how is this going to turn out? And on the start of this, there were a lot of question marks about that, but we're getting a clearer and clearer picture every day. One of the latest statistics that's come out is 92% of the people that entered forbearance have come out of it, according to Black Knight. And those that have come out as of March 31st, here's the clearest picture. And you, again, if you follow the monthly market report, you're familiar with this slide. 37% in the green area were paid in full. Those are the ones that, took forbearance maybe as an insurance policy and said, I don't know what's going to happen, and they didn't need it. 44.6, the blue shaded area, went through some kind of workout with their bank, either a modification, a rate and term refinance, or a deferral. They tacked it on the back. So 4 out of 5 people either went through a modification or paid it off in full, and there were no issues. So that's a very, very positive sign. Now, there are 18% that are still, in some sort of trouble. We don't know. They have no loss mitigation plan. They're already into a loss mitigation plan. But the bottom line is you talk about crash, this is not going to factor into crash because people have options today. If you have been negatively affected by the pandemic, you sell your home with the appreciation that you've seen over the last couple of years. Pay a commission, put some money in your pocket, and get to the other side of the crisis that you and your family are experiencing. So 2 things there: understanding why we had the housing crisis back in 2008, and then understanding the current piece of forbearance is critically important. But the bottom line is here, and Daniel Hale says it well, we've learned from history that prices can fall. The important question now, if that's going to happen right now, and it's really hard to say, meaning it's hard to say that will happen because things are very, very different today. And I want to walk through a couple of graphics that do a good job of visually communicating how things are different today. So let's go back to 2008. Loose lending standards drive the housing crisis, and let's look at where we are today. Well, the bottom line is lending standards are nothing like they were in the early 2000s. You know, if you think back then, we talked about the loans that were in the market. We talked about the things that, you know, people had done that caused the crisis. Well, there's two components that this report by the Urban Institute outlined. First is product risk in the mortgage business, and second is borrower risk. So the red area there, product risk, think about that as the types of loans that are available to people. And that's been virtually eliminated. You start back on the left side of 1999, come all the way to 2021. You see that red portion, it's gone. It's not there. The loans that were available back then are not available today. The brown portion there of borrower risk, think about that as, you know, asset profile, credit score, all the things it takes to qualify for a loan. Those have been severely curtailed. It's gotten harder to qualify for a loan after the housing crisis. You know, that's when the qualified mortgage came out, demonstrate the ability to repay, all the things that we know about the mortgage business, about how hard it's gotten to qualify. This graphic tells the story of the differences today between back then. And if you need further proof of how this is playing out in the market, this has really led to a, you know, sort of a foreclosure market in this country that's at an all-time low. Now, the last couple of years, certainly there's been a moratorium in place, and you know, federal government has stepped in and said, look, we're not going to process these foreclosures during the pandemic, and those are coming back, and we've talked about that on the monthly market report. But back during the housing crisis, the areas there that are shaded in red, over 9 million people went through foreclosure. And we certainly don't want to see anybody go through that. That's a tragic thing, but it's also a reality of our business. That's going to happen. But these you know, tighter lending standards have led to less foreclosures in the market. Now, that makes a lot of sense, right? If you have a highly qualified or a better qualified borrower, you're going to see less defaults, and we're seeing exactly that. That certainly is not going to play into a crash. And if you needed, you know, further example of that, this is a look at the loans that have been given to people with a credit score less than 620. So again, go back to the housing crisis. So many loans, this is in volume, in billions of loans with a credit score less than 620. And where do we stand as the third quarter of 2021, the most recent information from the Federal Reserve, a fraction of where we were back then. So we can clearly say lending standards are different. That story is different. One of the major contributors back in 2008 is not around. The other question that a lot of people bring up is, well, as homes get expensive, as homes have risen, people aren't going to be able to support that debt, and that's a challenge. Well, mortgage debt is not a challenge. Again, this is from the Federal Reserve. This is the household debt service ratio for mortgages, and that's as a percentage of disposable personal income. So think about the total mortgage payments divided by the total disposable personal income. And where we sit today is much, much lower than where we were in the financial crisis, even lower than we were in the 80s and 90s. And why is that? That's a component of rising wages. That's a component of interest rates that we've seen. And folks, you know, that are holding mortgages today are in a much, much better position than where they, you know, were back in the financial crisis, the housing crisis of 2008. And I think there's a lesson, you know, from that we can take away, is a lot of people said, you know, coming out of the housing crisis, we don't want to do this again. We're going to maybe pay down on our mortgage. We're going to put more money down. We're not going to cash out the equity that we have in our home. And you can see it in the numbers that are coming out today. And what I'm going to show you next is the cash out refinance numbers. And I think they tell the same story. This is a look at mortgage payments on cash out refinances from Freddie Mac in the difference in the annual payment for cash out refinances. So you think about the previous payment and then the new payment after the cash out refinance on an annualized basis. back in '06 and '07, '08, $3,000 or $4,000 difference in the mortgage payment somebody was, jumping up to be able to go through a cash out refinance. Well, what do we see in 2020 and 2021? $66 and $34. Very, very little change in the mortgage payment as somebody goes for a cash out refinance. Certainly that speaks to the low interest rates we've seen, but it also speaks to people not refinancing and harvesting the equity from their home and going out and doing something else. A lot of lessons learned back in '08 where we can say, safely that the market dynamics are very, very different today in housing than what they were back then. So as that question comes up, use these visuals, have them on your phone maybe to have a conversation with somebody when they say, what do you think is going to happen with the market? And listen to what they think and then show them the facts about what's happening in the market today. The bigger question right now is what's ahead. I think many people right now asking, what is the rest of this year going to hold? We're here in May. The Fed started off the month by raising the Fed funds rate. A lot of questions about that and talks of, down the road, a recession, home prices are going up, interest rates are going up. So a lot of questions about what's ahead. Let me give you some perspective there. The most recent updated home price forecast from the 7 forecasters that we watch, these are for 2022 prices. Average of these forecasters is 9% appreciation. Many people saying our home's going to lose value later in the year. Certainly not what experts are saying for this year. If you see these experts, they start to fall between 8 and 10%. We started off the year at about 5% appreciation, and we've risen slowly each month since then. We said these forecasters had a bias to the upside, meaning they were raising their forecast, and we're certainly seeing that today. So as people wonder what's going to happen with home prices, use this graphic to communicate this is what experts are saying, and bring your own local knowledge into that as well to what you see happening in your market. If we look beyond this year, the home price expectation survey as of the first quarter of this year, they're again calling for 9% appreciation this year. We see, alignment there with the average of the forecasters for this year. And then beyond this year, moving into what I'm going to call a much more normal rate of appreciation. Before the pandemic, the average appreciation of home was about 3.8% in this country. And you see us right in that neighborhood for, the next 4 years after this year. So anybody wondering, is this the top of the market? Should I buy right now? Forecast for price appreciation going forward may help them in making a powerful and confident decision. What the home price expectation survey does as well is they look at cumulative house price appreciation by 2026. And if we look at these, they sort of rank them by the optimist, the pessimist, and then the average of all panelists in the middle. Optimists say 46.5% appreciation, pessimists 10% appreciation, all the panelists 26% appreciation by 2026. So depending on where you sit, I think even if you're a pessimist in this market, they're calling for appreciation here between now and 2026. And again, I think a lot of people saying, I'm going to sit on the sidelines, I'm going to wait for prices to drop. And these forecasts say, I don't know that that's going to happen. And I think it's important that we get that in the hands of folks that are thinking about buying today. When we talk about rates right now, we've certainly seen rates in the first 4 months of this year rise dramatically. We started the year about 3.1%. Right now, we're just over 5.25% on the average 30-year fixed. Bill McBride says this: based on the current estimate for the peak Fed funds rate, somewhere between 3.25% and 4%, the 30-year fixed mortgage will likely peak between 5% and 5.7%. There are some variability in relationships, so we might see rates as high as the low 6s. This all depends on inflation and the Fed funds rate, but I don't expect rates to move much higher than the current rate, although 6 is possible. So seeing here from Bill McBride saying, hey, 6 is likely the top end. There's a lot of things that play into interest rates. It's certainly not going to sound like that's an easy dynamic to forecast, but let's look at inflation. That's what we need to be looking. Inflation is the enemy of long-term interest rates. So the Fed's action is to tame inflation. So we're going to watch that. But, Bill McBride here saying, I think the high side in this is in the 6s. So I hope that helps you give good advice to those you're serving about what's coming this year. I'm going to turn it over to Kate to talk about affordability, another hot topic here in the market. So Kate, I'll turn it over to you.
Thank you so much, David. I think a lot of what you're talking about with prices rising, mortgage rates projected to continue rising is really making people have questions about affordability. So what I'm going to do today is walk through where affordability is right now and what it means for the housing market going forward. And I want to start with this quote from Bloomberg. And they're quoting the Harris poll saying, new data from the Harris poll show 84% of Americans plan to cut back spending as a result of price spikes. More than 70% of respondents said they're feeling the effects of inflation the most in gas prices and groceries. I think we can all relate to this. We felt it at the gas pump, the grocery store. Prices are rising all around us, and it's impacting what we can spend on a day-to-day basis. Now, for someone who's thinking about buying a home, that's a real concern, and it brings affordability into the equation. So, where I think this is really impactful and really puts the most pressure is on that first-time home buyer, that person who is looking to really jump into the housing market, build their net worth, grow their financial future, and it's becoming more challenging to do that. So what our team has done is gone back and put some numbers behind this so we can really see how it's played out over the past year or so. And when we think about this chart right here, this is the change in mortgage payment. It goes back to January of 2021. This is based on a loan amount of $300,000, principal and interest only. But if you look at January of 2021, mortgage rates were at historic lows. So a typical mortgage payment was about $1,200, a little north of that. And, fast forward to where we are today in this rising mortgage rate environment, and things are different. If we think about where mortgage rates are projected to go, and let's say, mortgage rates later this year are around 5.5%, as we look at what the experts are saying and what's projected to happen, that mortgage payment jumps up to over $1,700. So if you're talking about $1,200 to $1,700, that's roughly a $500 difference. And that's putting a lot of concerns in people's minds as they're thinking about, and it's costing more not only to buy a home, but also on all the other, pressures around me, like we said, gas pump, grocery store, all those things. So, that first time home buyer in particular feels this pressure. And what I want to do next is put this into context, because that's something that we love to do, is really show the bigger picture. And what we can see right now is that affordability is really approaching more historical levels. So this is the Housing Affordability Index. It goes all the way back to 1990. And if you follow along with us, you've definitely seen this before. But really how to break this down and look at it is that the higher the bar, the more affordable homes are. Now, if you look at where we are over on the right today at 135.4, that's the index that NAR is measuring here. That homes are not as affordable as they were over the past 10 or 12 years, and certainly not as affordable as they were in those orange bars, which was the housing crisis. That's when distressed properties dominated the market. So, homes were being sold at a massive discount. We're certainly not there, but as we've seen prices rise, mortgage rates rise, we're not homes are not as affordable as they were even over the past couple of years. And it's important to remember that affordability is really a measure of three key things. We mentioned prices and mortgage rates, but it's also wages. And right now, all three of those things are ticking up. But, historically, over the past couple of years, mortgage rates have kind of offset some of the rising prices. Well, we're not sitting in that seat anymore. So people are feeling affordability challenges. Now, the context that we love to add here is if you go all the way back to 1990, what we can see is that homes are more affordable than any time leading up to the housing crisis. So I think that context is really key as we're having this conversation. When people say homes aren't affordable anymore, we have to say as compared to when. Now, I want to continue on and share this quote from NAR because I think this also helps paint a picture of what's really happening in the world around us. It says, the average consumer is spending an additional $429 monthly for items other than shelter. Meanwhile, the average weekly wages rose just $212 per month. So the consumer is short by $217 per month. So that's all of those direct results of inflation and the things that we're seeing around us and how it just simply costs more right now. So this means the average consumer will be looking for a home that is $41,793 cheaper. So the average consumer that's looking to buy a home is reducing their price point. That is very real. That is exactly what these dollars and cents are saying. However, the big concern I think that a lot of agents have on their mind is, does this mean that this is going to impact sales? Rising mortgage rates, we know that's going to impact slightly. People are going to make a decision. They're either going to jump in and they're going to say, yes, I want to get ahead of this. I want to get ahead of rising rates, rising prices, or they're going to say, you know what, this isn't for me. So it's going to cause people to make a decision. But the overall takeaway is that buyer demand is still strong. This will not impact the overall demand that we're seeing right now. So many buyers in the market and so few homes for sale. Changing needs, buyer demand is very, very real. So yes, it will put pressure on that lower price point buyer, but overall demand is still really, really strong. So, as we think about how do we communicate this out, how do we help our clients through this, it's about getting ahead of rising rates, rising prices, and really thinking about that long-term net worth development, net worth growth, financial future of buying a home. Now, as you have these conversations, what's most important right now is that relevant market opinion based upon facts. This is something we've been talking about a lot lately. Do I have a relevant market opinion based upon facts? Why is that so important right now? Because there are so many media headlines, concerns, fears out there, and your clients are going to lean on you as the trusted advisor if you have the data, the insights, the facts that back up your relevant market opinion. So as you coach your clients, as you help them through this process of buying a home and understanding affordability and making the best decision for where they are right now and where they want to go, having that relevant market opinion based upon facts is more critical than ever. So I hope that you can share these slides out there with your clients. You can get this message out there. Nothing changes if it all stops here. And one other way to get this message out here is to know that right around the corner, we have our summer buyer and seller guide release coming on June 3rd of this year. So brand new content to help your buyers and sellers wherever they are in the process as they're looking to buy or sell a home this summer. Really hyper relevant data, going to be super to get out there. And I hope you find this and the slides we've shared today helpful for this monthly market report.